Good afternoon and welcome to Ready, Set, Go Accounting for Leases Made Simple. My name is Jessica McClellan and I will be your moderator for today. Let's just hang on for one more second here while we make sure we get everybody in the meeting here. Alrighty. Again, my name is Jessica McClellan. Welcome to Ready, Set, Go Accounting for Leases Made Simple. Before we begin, just a few housekeeping items. During the presentation, we ask that all participants please remain in a listen-only mode, turning off your cameras. This is so we can decrease disruption and make sure that everyone is hearing the presentation. There will be a question and answer session at the end of the presentation using the questions submitted via the chat feature, which can be found down in the right-hand corner of your screen. Please go ahead and feel free to submit a question. It will be presented out to all the attendees. So if you've got a question, don't hesitate to ask, because probably 9 times out of 10, other people have the same question. So go ahead and submit that, and we'll get to those questions at the end of the session. We're going to leave about 10 minutes for our panelists to answer those. Finally, a recording of the session of this webinar will be made available in the coming days, probably tomorrow. So stay tuned. So let's begin. As most of you know, the new ASC 842 lease accounting standards present significant business implications, not to mention the financial reporting requirements are not a walk in the park. To successfully comply, companies must be proactive in developing a practical approach for compliance. For some organizations, this may involve the use of technology to help ease the process and create efficiencies. Today, we've brought together a stellar group, which includes NetGain, a software powerhouse that helps automate the accounting for leases process. In addition, we have our lead here internally from Vaughan Company. So with us today, we have Julie Seward. She's a senior manager with Vaughan Company's audit department. Julie has been instrumental in leading our lease accounting initiative and assisting clients with their adoption. She's well-versed in the lease standards and implementation challenges. In addition, we have Weston Lampe from NetGain, who brings more than 5 years of experience consulting specifically on lease accounting, and in addition to being a former auditor. So welcome to you both. I'm going to hand it over now to Julie, who's going to give you a high-level summary of what has changed and what that means for you. All right, Julie, go ahead.
Thanks, Jessica, and thanks everyone for joining us today. I think we've been talking about this lease guidance now for about 10 years. I was going through some email the other day and found a PowerPoint from well over 10 years ago about the lease guidance and when companies would be required to comply with it. And I honestly think that we were all surprised this past fall when the guidance didn't get deferred again for private companies. But the fact is that it's here to stay, and all companies with reporting years starting after 1/1 of 22 are now required to comply with the new guidance. When we think back a couple of years, when we rolled out the revenue recognition guidance, for most companies, there was a lot of work that went into it, but you didn't really feel a lot of change. With the leasing guidance, there's going to be a lot of change, and our goal is to try to make it as little work as possible for our clients to make the process go smooth and get through it as quickly as possible. So when we say the new leasing guidance or ASC 842, what are we referring to, and how is that going to impact a lot of our clients or companies out there? Well, the biggest thing is that now all leases that have original maturity of more than 12 months or that are not deemed immaterial will be required to report it on the balance sheet. So you will see a long-term asset, what we call a right of use asset, and then a short-term and long-term component of a related liability. Additionally, we are going to give you another page or so of financial footnote disclosures in your financial statements. And also, there's a potential that this will cause some covenant issues depending on if you have covenants and what those covenants are. Vaughan has tried to be very proactive. We've actually met with, I think, 12 to 14 of the banks already this year, and just talked to them to make sure that they are aware, which most of them have, are aware of it and are working with their clients to figure out what they're going to do to get over those hurdles. So we really encourage everyone to be looking at their covenants. And if you have something that, especially anything that has a, current liabilities, net worth, depending on how those are worded, and specifically what the add backs are for like an EBITDA calculation, whether you can add back interest expense or not related to debt, or whether that can be for anything. To take a look at those now and have the conversations with your banks up front to make sure that we're not getting till December and having a moment where we realize that we're going to have an issue. There are several practical expedients out there, and Weston will touch on those in a little bit. But essentially, those were part of the guidance, and the goal is to help make the transition easier for companies. But we also wanted to find a tool to help make the accounting, the actual debits and credits easier and make the process go as seamless as possible. We spent a decent amount of time internally demoing softwares, doing research on the different softwares out there when we came across Netlease. And from the time that we've spent on the other softwares, we have clients, we've worked on other clients that have used other products out there on the market. There's nothing that really compares to their product. It is extremely easy, user-friendly. The nice part is that they have what we call a SOC report. So for those clients out there or companies out there that were required to have a financial statement audit, we are able to get a copy of their SOC report, and then we're able to essentially rely on that, which will significantly reduce the testing that we have to perform. The software is able to generate all the information for the monthly journal entries, and then also produces the information for the footnote disclosures. And the other part is that they're very cost competitive out there in the market. It really depends on how many leases that you have, but on average, you're looking from somewhere between $40 to $100 per lease per year. And so we're all, here, one thing we all can share in common now is that no one seems to have enough hands to get all the work done. And to do the calculation monthly is a very manual, time-consuming process. So the nice part about using their tool is that you're able to put the information in on day one. It takes 15-20 minutes to get a lease in there, and it spits out all the information that you'll need over the life of the lease. So it's really been a nice tool to be a nice option to bring to our clients, to not burden them with extra work, to be able to offer this solution to help them with the process. So with that, I'm going to hand it over to Weston, and he's going to talk a little bit more, get in a little bit more detail about some of the guidance, and then also walk us through a demo of the software to show us how easy it really is to use the tool.
Perfect. Yeah, thanks, Julie. And thanks for joining, everybody. Just to reiterate what Jessica said, I've been in lease accounting since 2017. And back then it was supposed to be, a 2 to 3 year endeavor. But I won't spend much time on this. The main point of this slide that I want to get across is that the standard has been delayed 2 different times. And essentially that's due to the publicly traded companies just kind of ringing the bell for how difficult and how everyone pretty much underestimated the amount of time spent adhering to this new standard. Back in 2018, when I was working with publicly traded companies, and implementation commonly took 14 to 20 months. Now that's been trimmed down to an afternoon with Julie and her team at William Vaughan in conjunction with Netlease, and the ease of use of the software, like Julie stated. So Julie walked through this, but just to kind of contextualize and visualize the number one change that every client needs to be aware of, and why this is being called the biggest change in accounting in over 50 years, is because it has a huge balance sheet impact for almost every single privately held company out there. So all of those off balance sheet operating lease obligations that you used to be able to tuck away in the footnote, those are now front and center on your balance sheet. And like Julie stated, you'll have a right to use asset and a corresponding lease liability that will be the same or close to the same number. So it is a balance sheet gross up activity, but it's significant. Especially, we'll walk through a few lease examples in the software, but it doesn't take too long of an office lease, for example, to get into 6 figures or 7 figures of balance sheet impact. So it's important to work with William Vaughan this summer and fall to be prepared for when the troops come for the audit next winter, because it's going to be a material change to your financial statements in all likelihood. If you just have even 1 or 2 real estate leases, the standard is really, it's just much more complex. And again, almost every client underestimates the difficulty in implementation, which is almost always, in my experience, around just the data gathering and the collection of those leases. If you can have your data in order, Julie's team in conjunction with Netlease can really make it a seamless transition. But it definitely relies on clients being prepared when William Vaughan rolls into town. So the next 2 slides, I just want to kind of illustrate really in just journal entry form how the standard became more complex. So we'll walk through an example here of the same lease under 840 and 842. So this is a 3-year operating lease with $500 a month payments. And under 840, and what you've been doing for the last few years is just debiting that straight line vehicle expense and then crediting your accounts payable or your cash out the door. Under the new standard, that exact same lease, this is what the journal entry structure starts to look like. So again, the same fact patterns, the exact same, very simple, non-escalating vehicle payment for 3 years results in an initial journal entry of debiting the right of use asset account for nearly $16,000 and then crediting the lease liability account for the same amount. So again, no operational changes in the business, but now just out of nowhere, you have $17,000 of balance sheet impact for a simple vehicle lease. And then each corresponding monthly entry also became slightly more complex as well. So you're still going to debit, you're going to straight line that lease expense and debit lease expense each month, but now you're going to spend the next 3 years burning down that lease liability account you've created, as well as accumulating amortization against the right of use asset. And then, you still have your cash out the door each month of $500. If you look at month 1, we were debiting lease liability for $430. Now in month 2, we're at $432. So there is an effective interest kind of buildup there, which you'll be able to visualize in the system because as part of the new standard and creating that initial balance journal entry, you basically need to know the entirety of the accounting lifespan of this lease at commencement, because you need to have all of the parameters in place in order to properly calculate that initial balance entry. So you'll be able to see the entire lease accounting schedule for this lease upon commencement. You'll be able to have great insight and predictability into future expenses and future journal entries using the tool, because you'll have all of that information gathered at commencement. So walking through some of the technicalities of the new standard. So there's 2 main lease classifications under 842. So there's operating leases, which again are going to operate relatively similarly as under 840, with a huge caveat that now you also have to book that initial balance journal entry. So there is going to be balance sheet impact, and then you will be straight lining the lease expense over the life of the operating lease. And operating leases make up, they estimate around 80 to 90% of all leases. So you can imagine the balance sheet impact there. I know there was an article on Bloomberg that estimated over $3 trillion in the United States will be added to balance sheets just due to this standard. So again, the balance sheet impact for operating leases is the biggest change here. Financing type leases. So those are essentially a rebrand of capital leases under 840. You're going to recognize interest expense and amortization expense over the life of the lease, and you still will create that right of use asset and lease liability, which is not too different than how capital leases were housed or held under 840. They're still going to remain on the balance sheet. And then there's two ways that you can circumvent 842, but they are, they do have their own set of rules around them. So short-term leases, this one's pretty straightforward. If your lease is under 12 months, you'll just straight line that expense, which with a short-term lease is likely just cash each month. and no escalations, but regardless, you'll be straight lining that, and there'll be no balance sheet impact. And then low value leases. These leases are, you'll work with William Vaughan to determine kind of what a suitable low value threshold is for your portfolio. And any leases that are immaterial will fall under a similar accounting pattern as short-term leases, where you will be simply straight lining the expense, and there'll be no balance sheet impact there. But that is something you'll want to work with William Vaughan, in the coming months to establish. It's a new accounting policy election, essentially. So, if you have a fixed asset capitalization policy, it'll be a similar theory there. Well, you'll want to have it documented. And I'll breeze through these scope exclusions, but there are, outside of short-term and low-value leases, there are a few types of leases that are explicitly excluded from 842. They tend to be industrial in nature, except for the first one, which is leases of intangible assets will still fall under goodwill and other. Leases to explore areas for mining and natural resources, those still fall under topic 930. However, if you have a lease to mine somewhere, but you also have excavators and backhoes and equipment there, those leases will still be included under 842. It's explicitly the lease to explore the land. Leases of biological assets, namely timber, that's going to continue to be accounted for under topic 905. Inventory already has a complex enough standard. It's going to stay there. And then leases of assets under construction will continue to fall under 360 PP&E. So now is where kind of when rubber meets the road. There's some areas that, despite having hundreds of pages of guidance from FASB, there's still some gray area. And this is, topic number one, where you'll want to be in constant communication with William Vaughan around related party leases. These are extremely common for privately held companies. I'm sure a majority of the people on this call have related party leases. And they are not excluded from ASC 842. In fact, they can cause some challenges. And that's mostly because a lot of related party leases do not have proper documentation. If you have related party leases that you're worried about, my number one recommendation would be get those in writing immediately. Just have the term and the payment streams, if nothing else, because the whole crux of the new standard is to properly include in the financials all legally enforceable obligations for a client. So even if it's a related party lease, if the underlying economics suggest that, for example, you have a warehouse that's specialized for your business, it's being, leased in a related party transaction, but this warehouse, there's no way that you're actually going to abandon this warehouse within the next 12 months. And, it's likely to be utilized for 8 or 12 years, then that's the lease term that's going to be used under the new standard. So again, I think it'll make, from the client accounting side, as well as from the audit side, life a lot easier if you just get all of these related party leases documented. It doesn't have to be a 20-page lease agreement. Just put it in a simple lease agreement that, again, explicitly lays out the term, lease term, as well as the payment streams going forward. All right, so now we'll move into the practical expedients that were made available under US GAAP. And again, a lot of these were created because the publicly traded companies had such a difficult time implementing under the new standard. So there's a few of these that actually are not available for publicly traded companies and are only available for those of us that are lucky enough to work at a privately held company. So I'll walk through the various entity policy elections here, as well as the transition reliefs that are offered under US GAAP. So again, short-term low-value leases is a policy election you have to make. So you'll just want to document that you are electing to exclude short-term and low-value leases from your portfolio. If any of you have dual reporting under IFRS, IFRS actually provides a bright line of $5,000 or less is what a low value lease is. But like I said, you'll want to work with your William Vaughan audit team on establishing an internal policy under US GAAP because there is no such $5,000 bright line limit. The next one is around one of the more complex areas of the standard, lease and non-lease components. So lease components are your base rent, your minimum rental obligations. Those are obviously included in that NPV calc at the beginning to establish the balance sheet impact. Non-lease components, the one I like to use as an example the most is CAM charges, so common area maintenance. So if at all available, it'll make your life a lot more simple. If you have known estimatable CAM payments, you can elect to include those with the base rent payments and capitalize that entire value. And then the reason why that is suggested, or you'll at least want to explore it with your William Vaughan team, is because if you separate those, then you actually have to do a standalone selling price analysis and allocate a portion of the total fixed cost to lease expense, and the rest goes to maintenance expense. But if at all available based on your data and lease structure, you do have the option to combine those, which will increase the balance sheet impact, but will make the accounting a little more simplified going forward. And then right after related parties, the next hottest topic is definitely the discount rate utilized. So this is, again, probably the biggest area you'll want to work with William Vaughan is just understanding the 3 different rates that are made available under the new standard. So I'll kind of quickly walk through them. And they are in order of preference under US GAAP. So the first and most accurate discount rate, which again, you're going to use to discount all of the future cash flows and establish that initial balance. The first one is the rate implicit in the lease. That's essentially the lessor's profit margin. So, it's rare that you'll have that information because you need multiple inputs from the lessor, including the fair market value of the asset, any expected residual value, et cetera. But if you do have that information available, that is the most accurate discounting rate. But again, it's definitely the least utilized just due to the lack of availability in most cases. The second rate is the incremental borrowing rate. So this is essentially what would my interest rate be if I wanted to borrow money to obtain an asset, a similar asset collateralized by the asset for a similar lease term. And that's the incremental borrowing rate. Again, work with your auditors to, determine if you have that information available. And if it makes sense, because it will have a higher interest rate than the third and probably most common discount rate used, which was not made available to publicly traded companies, is just utilizing the risk-free rate. So, in the US, we typically view that as the US Treasury bills. So you would use the T-bill rate at the date of your lease commencement for a similar lease term, and that would be the rate you would use to discount the cash flows. Another just important point around discount rates in general is that you'll be using the discount rate at your transition date. And then going forward, anytime you enter into a new lease, you'll use the discount rate at the month of commencement of that lease. And then portfolio approach sounds a little better than it actually is, or is maybe not utilized as much as FASB thought it might be. This is where you can account for extremely homogeneous leases as a portfolio, so one amortization schedule essentially. So, but they have to be, essentially identical. They have to have, the same lease start date and end date, have to be, a similar asset class, which might not sound that rare, but the other wrinkle is you're accounting for that as one giant lease. And then if there are any changes within the portfolio, if it's a fleet of vehicles and you're swapping out vehicles or terminating some of them early, then the accounting can be kind of hard to peel that out of that initial group amortization schedule. So in general, most people end up booking all of their leases individually. A couple of the transition reliefs here. Use of hindsight, I won't spend much time on this because it's almost never elected, but essentially you can go back and use hindsight to reevaluate like whether or not a renewal option was likely to be exercised. Maybe when you created this lease 4 years ago under 840, you said it was not likely to be exercised, but in the 3 or 4 years before transition, you actually decided it is likely. You could go back and change those accounting decisions using hindsight, but you have to do it across your entire portfolio. So it's a huge time suck and rarely utilized in my experience. The next transition relief is utilized almost all of the time. So once again, work with your audit team to learn about these and how they would, potentially affect your portfolio. But the package of practical expedients. So all three of these need to be elected. It's a all or nothing deal. It's almost universally elected. And the moral of the story is essentially you don't need to reevaluate your decisions you made under 840. The biggest one is lease classification. So when you're transitioning, you don't need to go back and determine if your operating leases were properly classified. If you elect this expedient, your operating leases roll forward into 842 as operating leases, and your capital leases get a facelift and are now called financing leases, but you don't actually need to, prove those decisions out again. So here's just an illustration, and then we'll dive into the demo. But really, there's a lot of data that's required in order to get to those three outputs on the right, which are, the whole reason to use Netlease or any software in general. To get those journal entries systematically created, which Julie and the auditors always love anything that's created from a system instead of somebody's Excel sheet. And then the disclosure reports will automatically be created by the system as well, along with 20 plus other reports that can be used for forecasting and roll forward reports, cost analysis. There's many reports out there. So all of the various inputs here are pieces of lease information that you're going to need, and you should start gathering that information today, basically. Because you're going to need to go through your lease agreements, gather all of this information, get it into one central repository. And then at that point, your transition is going to be so much smoother. Again, I think the demo will do a better job of pitching this than I will on this slide. I'm an accountant, not a sales guy. But using Netlease, essentially, again, like Julie mentioned, we're definitely on the lower end of the cost spectrum in the marketplace. And we might be north of 600 customers at this point. Our customer base ranges from very huge, notable, publicly traded companies. And then our sweet spot is really those privately held companies that are looking for a tool that is, user-friendly, easy to use, and most importantly, reliable. William Vaughan has, like Julie said, spent a lot of time vetting the tool over the past year, and landed in a partnership with us due to that ease of use and general reliability of the product. So with that, I think unless Julie, if you have any additional thoughts, otherwise we can jump into the demonstration.
I think you've covered everything pretty well.
Perfect. So I will start sharing my account now. All right, so this is Netlease. Again, it's a web-based application. If I didn't already mention that, your business would receive its own unique, secure URL. And the beauty is that you actually are able to assign William Vaughan as your audit firm, and there's some seamless read-only auditor access that is created there. So I'm going to walk through the system at a fairly high level here. We'll create a lease, we'll run some reports, and then we'll go through the administrative process as well, and how to customize your account, as well as add users and things like that. It's all fairly straightforward. So if I look at my lease portfolio here, I have 4 leases. I have leases of varying types. So I have real estate, equipment, vehicles, a couple operating leases, a couple financing leases. And just one thing to note, I'll be creating a lease here through the UI using this new lease button. But all of our information can be uploaded in a CSV template, or can be mass updated as well. So I'm going to go through here. I'm going to create a new lease. So we'll call this lease the Toledo office. We'll say this is a real estate lease. Oops, I need to refresh my system quick. Apologies. I had it stale for an hour or two in the background. And with this, I'll create an office lease here. All right. Real estate type lease, lease classification. So again, if you're transitioning using the package of practical expedience, you're just going to be rolling forward these lease classifications. So I'll say I know this is an operating lease, but I'll walk through. The system also has a wizard that you can go through the 5 criterion and actually prove out your hypothesis on classification for new leases going forward. And again, it's very auditor friendly, which is, I think, the reason most of us are on the call today. So I have my primary information here. Again, it's a real estate operating lease. You can enter in any notes here in the free text field. And then now I get down to the schedule information, which is really, the parameters of the amortization schedule. This is where all of the accounting, again, is going to be created on the front end. And then unless there's a change, such as a modification or a termination, you're going to know the accounting from the very beginning. So I'll say this lease goes until 2020, 2025. So you have a 4-year lease. I'm going to set up the payment streams now. We'll say this is a lease that has escalating payments. We start out at $10,000 a month, and you can set up really any realistic payment frequency here. So monthly, one time, annually, quarterly, and the system is going to still straight line that lease expense for us, but it's going to obviously properly distribute the cash flows and the journal entries associated with those throughout the years. So if it's an annual lease, you're going to only have cash payments at the beginning or end of each year. So I'm going to make this a monthly payment lease, escalating $1,000 each year. Under the accounting overrides, this is where I'll select, are the payments made at the beginning or the end of each month? It will have a small immaterial, but it will have an effect on the NPV calc, just based on discounting those cash flows and whether or not they're in advance or arrears each month. Moving back up into the schedule information, if you have initial direct costs, prepaid lease payments, or lease incentives under the new standard, you would enter those in here, and those will affect the right of use asset. And any of the fields with the little blue information help icon, we just have a sentence or two there in layman's terms of what this field actually does, as well as, if you're really want to dig into the codification, if you go to US GAAP 842-20-30-5, you'll be able to read up on prepaid lease payments and how they're going to affect your lease under the new standard. So incremental borrowing rate, again, that's where you'll want to work with William Vaughan's team. It is a real exercise. And it's a little bit of a pain, but it's hugely impactful to the financial statements. So we'll say that we have a discount rate here of 5%. And now that I have that information in the system, I have enough info to come up here and click on Create Lease. And what this is going to do is it's going to create this lease for me. So in a matter of seconds here, I have my full amortization schedule for the life of this lease. So you can see, again, this 4-year lease with 10 to $13,000 payments, has almost a $500,000 initial balance journal entry. So when we run the journal entry report, I'm going to see a debit to the right of use asset account for $498,000 and a credit to the lease liability account for the same amount. And then moving through the schedule, you can see my payments go from $10,000 to $11,000 to $12,000, and then my schedule ends at $13,000 after the 4 years. And you can see that lease expense, though, is the straight line value over the life of this lease, $11,500. And again, this is an operating lease. So if I were to create a financing lease, the schedule would be slightly different, and it would have an interest expense component as well as amortization expense. So I'm gonna, and one other thing to note, if you want to see this lease in Excel, you simply click on Export Schedule. And in a matter of a second or two, I have this schedule that I just built in Excel that I can, shoot around the company or to the auditors, et cetera. So I'm going to put this into edit mode and walk through some of the other new fields that have popped up now that I've created the lease. So we have our payment streams, which we already created, accounting as well. So for each, any client can create up to 4 custom segments here. And then you'll be able to assign, if you have entities or subsidiaries, you can name the custom categories as well as populate the actual values you want. And you'll be able to assign custom segmentation data to the lease. Modifications, I'll walk through one quickly. Once we modify this lease, or if you were to terminate this lease, that information is going to be held here, and then you can kind of drill in and see the modification afterwards. Provisions, this is where you would add in if you have renewal options or expansion options. If you have an HVAC maintenance provision, you can add in, we have over 30 custom provision types. You add in the information, and again, you'll have a running list of all the provisions there. So really the goal is that once under this documents tab, once you upload the lease agreement and any amendments, any other supporting schedules, you don't have to open that PDF very often anymore because it's cumbersome to work through those. So what we like to do is on the front end, you build out the provisions, the payments, everything is taken care of so that you can log into the system and have a much more easily accessible information data set. And then lease classification, again, this is if you want to document your lease classification decision making. So we walk through the 5 criterion under the new standard. And if any of the 5 are triggered, the lease moves from operating to financing. So does the lease transfer ownership at the end? Yes, now it's a financing type lease, but I'll switch it back to no. And you can walk through these, you can save your notes in here, and then this will obviously be very handy when the auditors roll into town. So with that, I'll get out of edit mode, and you can see the status here is draft, and explicitly it's excluded from reporting. So this lease is not being recognized as part of my accounting portfolio at this time. But now I'll go to commence this lease, which is going to change the status from draft to active. And now, again, after I've reviewed this lease, I'm comfortable with the terms and the schedule. I've changed it to active status. So now this is going to be included in my reporting. The other thing that does is it now allows us to modify or terminate this lease. So I'll go to, I'll modify this lease quickly. So up top, I have my current lease information. And then now I have my modification information on the middle of the screen here. We support standard modifications, decreases in scope, right of use asset impairments, partial terminations. We'll do a standard modification. We'll say that now this lease is 60 months long. We've extended for a year. The effective date of the modification, this is important. This is when does the modification journal entry happen and when does the accounting change going forward. So we'll say that we decided this month in July to extend the lease and exercise that 1-year renewal option. And with that, I will add in the new year of payments for the 5th year. So I'll add in $14,000 a month. I'll click modify lease. And now the system's already done performing that modification within the amortization schedule. So if I see here, when I go down to July, I have 2 journal entries now, or 2 amortization lines, I should say. The first one is the modification journal entry or modification line, and then we get back to our normal amortization. But if you look at this modification, adding that additional year of payments resulted in $137,000 of balance sheet gross up. So when we run the journal entries next, we'll see a debit to right-of-use asset for $138K almost, and a credit to liability. And then our straight line lease expense has now changed prospectively from the date of modification. And now our debit to lease expense each month is going to be just over $12,000 until the life of this lease, which now goes until December 2026. And if I go to my modifications tab, now I can see this modification information there as well. And also we have a full audit trail for really anything that happens in the system. You'll be able to dig in and see the details, the user who performed the change, as well as what fields were changed. So that's a modification. Terminations operate almost the exact same way. I won't walk through one, but you'll just walk through a simple wizard and it's going to perform the accounting for you, along with any potential gain or loss will be included in the journal entries as well. So with that, I'm going to dive into reporting next. So if I click on all reports, you can see we have a vast array of reports available out of the box, and all pre-configured on the back end based on your data, just out of the box. I'll filter these reports for journal entries, and then we'll walk through disclosures. But I'm going to run the journal entry report. So I'll click journal entry lease activity. And with all of our reports, you'll land on a filter screen here. So I'm going to run the reports for an entire year. You could run them for a month, quarter, a year, 3 years. It's really up to you. And then this group entries into single date button. So I'm running this for 12 months of journal entries. If I leave this box checked, I'm going to see, for example, lease expense as one 12-month sum debit to lease expense. If I uncheck it, I'm going to see each month's individual journal entry. So I'll do that. You can also filter the reports based on any specific custom segments, again, that you would create, and then you'd be able to filter that report accordingly. So again, in a half a second or so, we have this journal entry report that's been created. So now I will view this. Zoom in a little bit. So I can see my 5 leases in my portfolio here. So the Toledo office is the one that we just created. If I pop that lease open, I can see a little more detail around the journal entries that were created. So again, this created a journal entry for each month because I unchecked that group entries into single date field. So filtering here, highlighting just January, you can see we have a couple extra lines there in column C. We have the initial balance journal entry, which again is debiting right-of-use asset for $500,000 almost and crediting lease liability. And then the first 4 lines are our traditional and go forward amortization journal entry. So we're debiting lease expense, we're bringing down the liability, we're accumulating amortization against the asset, and then cash out of the door was $10,000 in month 1. You can also see these account numbers. So each client can set up their own specific account numbers by lease type. So lease expense for real estate leases, I set up as, it's account 6,000, but maybe my vehicle lease expense is account 7,000, and you'll be able to customize that on the back end. As well as if I scroll over, my custom segments have flowed in as well. So I can see that, this lease is hitting entity number 1 and its department is corporate. And then wrapping up with the journal entry report, I just wanted to touch on that modification that we performed in June. So if I filter down, or July, I should say, if I go down to July, I can see, again, there's a couple additional lines. So I have the modification journal entry, debiting that right-of-use asset, crediting lease liability. And then I have my traditional amortization journal entry, but now my straight line lease expense, as we noted in the schedule, has changed to $12,062 instead of that $11,500. So just getting back to the bigger picture here. So you'll be able to see all of your leases and all of our reports. You can drill down and start seeing more and more information as you drill in. And the journal entry report, again, can be run, at any given time. And you could see your potential journal entries next year by filtering for those dates. Another report that I wanted to touch on, I'll filter for disclosure reports. Probably the number one reason to buy a software, especially one that plays in the price range that Netlease does, is for disclosures. They are an absolute bear to tackle in Excel. Julie's not going to let you pawn that work off onto her poor audit staff. So having the software create these out of the box is going to be a huge time save for everyone involved. And with all of the reports in general, we can, run a couple of these together at once, or if I want to select all, for example, now I'm going to run all of these disclosure reports at one time. And what this is going to do is it's going to create a single Excel file with all of the various disclosures on their own individual tabs. So I'm going to run the disclosure package for fiscal year or calendar year 2022. And now I have my disclosure package that's been created. So I will open this thing up and I'll filter out. My Excel cooperates. Oh, here we go. So again, all of the individual disclosures are housed on their own tab here. So I'll start with undiscounted lease maturity, for example. And let me filter out and zoom in so everybody can see it a little better. So all of the disclosures are based on or disclosed based on lease classification. So you'll have your operating and your financing. So here's my next 5 years of payments, payments thereafter, less imputed interest gets me back to my balance sheet liability. And if I want to see, for example, well, where's this $324,000 cash outflow in 2023 coming from? I can open that up and see it's, from these 3 leases. Here's the cash values there. Supplemental cash flow information as another example disclosure. I won't go through all of them. You have your operating cash flows, and I'll hide some columns here to get it all on the screen. You have your operating cash flows paid for operating leases, operating cash flows paid for interest of financing leases. If I want to see what that number is being made of, again, here's my financing leases, and then the actual month by month transactions as well. So, here's my 12 months of interest expense or interest portion of the operating cash flows for my F-150 financing type lease. The weighted average remaining lease term and weighted average incremental borrowing rate are 2 of the new disclosures under the new standard. So if I filter out for my operating leases here, the remaining average lease term is 5.71 years. For financing, it's 1.42 years. So that's how the disclosure package works. Again, it's super simple. It took 1 second to run that, and it's going to have all of your information available within there. And then wrapping up, I just wanted to touch on some of the administrative portion as well. So again, as I'm setting up my firm here or my my business, Midwest Manufacturing, this is where I can set up custom lease types. So again, we have out of the box equipment, vehicles, and real estate. You can add new lease types. And then this is also where you would adjust those account numbers that are being hit. So my real estate leases, the right of use asset account that gets debited is 1001, but you can set those up on the lease type basis. And then also this is where you would set up the 4 custom segments here. So maybe one client calls it entity, but I call it subsidiary. And then I would be able to go in and actually add those values for my subsidiaries. And finally, if you do have either dual reporting or you're solely an IFRS reporter or GASB reporter, you'll set up your account as such. And then the forms will slightly change. So, for lease classification, for example, there's no operating leases under IFRS, so that wouldn't be available. Same with GASB. So it does change some of the accounting a little bit, but we'll be able to adhere to any of the standards. So that's a 20-25 minute view of the system. So I think I'll pause there and we can pop it back to Jessica to see if there's any questions or anything else that we want to walk through.
Yeah, thanks, Weston. We really appreciate it. As of right now, I don't have any questions in the chat feature. Julie, is there anything that you, any questions that you could think of that maybe someone might have? Or should we go ahead and get ready to close the event? I will say that we are recording this, so it will be made available to you guys. And if you have questions in the coming days, you can for sure reach out to Julie and our team.
I think Weston did a great job and covered it. So I can't think of anything else right now that might be helpful. But again, if something comes up subsequent to this, happy to have you reach out and we'll provide you with the right information.
Well, thanks both of you for being here. We really appreciate it, and hope everyone has a good rest of their day.
Thanks, everybody. Have a good day.
Bye.